It's happening. Lloyds, the stalwart of British banking, the sleeping giant, is stirring. Share prices are up, spiking in a way we haven't seen in years. This isn't some penny stock pump and dump scheme, folks. This is Lloyds, a cornerstone of the UK financial system. So, what's got the market so excited? Let's dive in. Analysts are buzzing. Could this be the start of a sustained bull run? Is Lloyds finally shaking off the post-Brexit blues and the pandemic hangover? The whispers are getting louder, the chatter more optimistic. But as with any market move, caution is warranted. We need to look beyond the headlines, beyond the hype, and understand the forces at play. This isn't just about Lloyds. This is about the UK economy, about interest rates, about global investor sentiment. It's about the complex interplay of factors that move markets, that create winners and losers. And right now, at least on the surface, Lloyds looks like it's positioned to win big. But remember, in the market, just like in life, there are no guarantees. Here's the thing. Banks love higher interest rates. And guess what? Interest rates are rising. The Bank of England, in an effort to tame inflation, has been steadily raising rates. This is music to the ears of banks like Lloyds, which make money from the spread between what they charge borrowers and what they pay depositors. Higher rates mean bigger profits for banks. It's that simple. And Lloyds, with its massive mortgage book, is particularly well positioned to benefit. As rates rise, so do their earnings. It's a simple yet powerful equation. But it's not just about the bottom line. Higher rates also tend to cool down the housing market. Why? Because mortgages become more expensive and fewer people can afford to buy. This cooling effect can actually be a good thing for banks like Lloyds. Think about it. A more stable housing market with slower, more sustainable growth is preferable to a boom and bust cycle. It reduces the risk of defaults, of people walking away from their mortgages when prices plummet. Stability in the long run is good for business. Remember Brexit? The never-ending saga that was supposed to cripple the UK economy? Well, guess what? It hasn't been all doom and gloom. In fact, for Lloyds, Brexit might just have a silver lining. How so? Well, one of the key concerns about Brexit was its potential impact on London's status as a global financial hub. Some predicted an exodus of banks and financial institutions, a mass relocation to mainland Europe. But that hasn't really happened. Sure, there's been some movement, some shifting of operations. But London is still London. It's still a global financial powerhouse, a magnet for talent and capital. And Lloyds, as one of the UK's largest banks, is well positioned to benefit from this continued dominance. Moreover, Brexit has forced UK businesses to become more competitive, to streamline their operations, to focus on efficiency. This newfound agility could translate into greater profitability, which would be good news for banks like Lloyds. Sentiment is a funny thing. It's fickle, it's unpredictable, and it can change on a dime. But right now, sentiment towards Lloyds is shifting, and it's shifting in a positive direction. Investors, both large and small, are starting to see the potential. They're seeing a bank that's well capitalised, that's profitable, that's paying dividends, and that's positioned to benefit from rising interest rates and a more stable housing market. This shift in sentiment is reflected in the share price. As more investors pile in, demand for Lloyds shares increases, driving the price higher. It's a classic case of supply and demand, playing out on the stock market. But remember, sentiment can change just as quickly as it turns positive. A few bad news cycles, a global economic slowdown, or even just a general market correction could send investors fleeing for the exits, driving the price back down. Let's be clear. Investing in Lloyds, or any bank for that matter, is not without its risks. Banks are inherently leveraged institutions, meaning they borrow a lot of money to lend out. This leverage magnifies both profits and losses. One of the biggest risks facing Lloyds is the potential for a sharp economic downturn. If the UK economy were to enter a recession, it could lead to a spike in loan defaults as businesses and individuals struggle to repay their debts. This would eat into Lloyds' profits and could even lead to losses. Another risk is the potential for further interest rate hikes by the Bank of England. While higher rates are generally good for banks, there's a tipping point. If rates rise too high, it could stifle economic growth and lead to a surge in loan defaults as borrowers struggle to keep up with their monthly payments. And then there's the ever-present risk of regulatory changes. The banking industry is heavily regulated, and new rules or regulations could impact Lloyds' profitability. For example, the UK government could introduce new taxes on banks or impose stricter lending requirements. One of the things that makes Lloyds particularly attractive to investors is its dividend. Lloyds is known for paying a generous dividend, which is a portion of its profits that it distributes to shareholders. Dividends are like a bonus for investors. They provide a steady stream of income, which can be reinvested back into the stock or used to supplement other income sources. For retirees or others looking for income-producing investments, dividends can be a major draw. Lloyds' dividend is not guaranteed, of course. The bank could decide to cut or suspend its dividend if it experiences financial difficulties. However, Lloyds has a long history of paying dividends, and the current dividend yield is attractive. This combination of a solid dividend and the potential for share price appreciation is what makes Lloyds so appealing to many investors. It's a way to participate in the potential upside of the UK economy while also receiving a steady stream of income. So, is Lloyds a buy? The short answer is, it depends. It depends on your risk tolerance, your investment goals, and your outlook for the UK economy. If you believe that the UK economy is headed for a soft landing, that inflation will be tamed, and that interest rates will stabilise at a level that supports economic growth, then Lloyds could be a good investment. The bank is well capitalised, profitable, and pays a healthy dividend. However, if you're more bearish on the UK economy, if you're concerned about the potential for a recession or a sharp rise in loan defaults, then Lloyds might not be the right investment for you. There are risks involved, as with any investment. Ultimately, the decision of whether or not to invest in Lloyds is a personal one. There's no right or wrong answer. The key is to do your research, to understand the risks and rewards, and to make an informed decision that's right for you.